Hold on, stop whatever you are doing. Pause. Close the other tabs, put the phone down, because what I am about to explain is not an opinion, not a projection, and not a warning about something that might happen. This already happened. At exactly 2 a.m. Swiss time, while markets were quiet and headlines were empty, Switzerland triggered a silent break in the global physical silver system. There were no announcements, no press releases, no media coverage. At 2 a.m., the Swiss Federal Customs Administration issued emergency export hold notices to the core of the silver market itself. Not traders, not exchanges, the refineries, the facilities that transform raw metal into deliverable silver bars. And in one administrative move, shipments above commercial size thresholds were placed on immediate hold. Not slowed, not reviewed casually, frozen solid. This is where most people misunderstand what matters. Silver isn't just a price on a screen. The entire market depends on continuous physical flow. Mines produce raw material, refineries purify it, dealers distribute it, industry consumes it. When that refining step stops, everything downstream starves. Paper prices can keep printing, charts can keep moving, but the metal itself doesn't appear by agreement. It has to physically move. What makes this moment dangerous isn't the drama, it is the timing. There was no gradual tightening, no early warning signs visible to the public. One moment, shipments were clearing customs. The next moment, they weren't. Dealers didn't prepare, mints didn't adjust, industrial buyers didn't hedge. The valve didn't just narrow, it slammed shut. And here's the reality most investors never consider. When a physical supply chain breaks quietly, the advantage doesn't go to institutions or headlines. It goes to the few who understand the structure before the story becomes public, before scarcity becomes visible, before behavior changes. That is why this matters right now, not next week, not after everyone is talking. This wasn't fear, this wasn't speculation. It was a structural failure at the bottleneck. And once you understand what Switzerland actually represents in this market, you will realize this was not accidental. It was strategic. If you are still following Type 1 in the comments, if this just changed how you think about silver Type 2. And if you want analysis that focuses on structure, not noise, make sure you are subscribed. To understand why this single action matters so much, you need to reset how you think about Switzerland. Most people see it as a small, neutral country. Mountains, banks, watches, chocolate. In the silver market, that perception is dangerously wrong. Switzerland isn't just a participant in the system, it is the system. Global silver production runs at roughly 1 billion ounces per year. That metal comes out of the ground in Peru, Mexico, China, Australia, and a handful of other regions. But what comes out of the ground isn't usable. It is concentrate. It is doré. It is impure. It cannot be delivered to a mint, a dealer, or a factory in that form. Before silver can function as sound money or material, it has to be refined. That refining step is the choke point, and roughly 70% of the world's refined silver flows through just 3 facilities, all located in southern Switzerland, clustered near the Italian border. For decades, these refineries invested while others shut down. They automated, they scaled, they built trust. Their hallmarks became the standard the world accepts without question. When silver needs to become real, it passes through Switzerland. The global supply chain evolved around that reality. Mines ship raw material to Switzerland. Switzerland purifies it, casts it, certifies it, and ships it back out. Dealers don't stockpile months of supply. Mints don't hoard excess blanks. Industrial users don't warehouse silver bars. The system runs lean, efficient, and just in time, and it works only as long as Switzerland keeps shipping. At exactly 2 a.m., that motion stopped. Not because mines failed, not because demand vanished, but because the refining hub was told to pause. When the hub stops, the spokes don't slowly weaken, they lose connection entirely. This is why calling this a Swiss issue misses the point completely. When the center freezes, the entire wheel locks. And the further you are from the hub, the more exposed you become. Dealers first, mints next, industry last, each layer discovering one by one that the supply they assumed would arrive simply is not coming. And here is the key insight. Markets can adapt to high prices. They cannot adapt to absent supply. Switzerland didn't just raise costs, it raised uncertainty, and uncertainty in physical markets is lethal. Now the question becomes unavoidable. Why would Switzerland do this, and why do it quietly at 2 a.m? Governments don't intervene in commodity flows unless something has already gone wrong behind the scenes. This was not routine oversight, it was an emergency response, and it was driven by pressure building from multiple directions at once. The first pressure point came from Asia. When China restricted refined silver exports, a supply artery feeding Switzerland went dry overnight. For years, a significant portion of Chinese refined silver flowed into Swiss refineries to be reprocessed, standardized, and stamped with hallmarks trusted by Western markets. That flow wasn't marginal. It filled capacity gaps, stabilized inventories, and kept shipments moving. When it stopped, Swiss refiners were forced to rely on inventories that were already thinner than normal. Demand didn't slow down. It accelerated. Industrial users, investors, and governments were all pulling on the same limited stock. Vaults that normally held comfortable buffers were being drawn down week after week. What looked like plenty on paper translated into days of supply in reality. At that point, refining efficiency no longer mattered. Inventory did. The second pressure came from Europe itself. Industrial buyers with long-term contracts began panicking. Contracts bonded when silver was cheap suddenly became liabilities for refineries as physical premiums exploded. Governments got involved, phone calls were made, legal risks appeared. Switzerland found itself caught between honoring industrial supply commitments and allowing open market exports that threatened to drain all remaining stock. And then there was the third pressure, the one that overrides all others' national interest. Switzerland produces no silver of its own. In a world where strategic materials are weaponized, relying entirely on imports is a vulnerability. Strategic reserves exist for a reason. When refineries reported falling inventories and rising global instability, the calculation became simple. Preserve domestic access first, sort out the rest later. Export freezes are not about markets, they are about control. And once a country chooses control over flow, the global system adjusts painfully. This wasn't panic, it was prioritization. And once that line is crossed, the consequences do not stay local. Once exports stopped, the damage didn't spread slowly, it cascaded. Physical supply chains don't fail in isolation, they fail in sequence. And the first group to feel it wasn't the investors, it was the dealers. Bullion dealers operate on thin margins and even thinner inventory. They don't warehouse months of metal because capital tied up in stock is capital not earning. Instead, they rely on predictable shipments arriving on schedule. When those shipments freeze and customs inventory doesn't decline gradually, it totally vanishes. Within days, dealers begin rationing. First quietly, then openly. Certain products disappear. Delivery times stretch out. Prices detach from screens. And when dealers run out, the market doesn't clear. It stops. You can't buy what doesn't exist. Next come the mints. Coin production depends on a steady supply of refined blanks. When refineries can't ship, blanks don't arrive. When blanks don't arrive, presses go idle. Iconic products disappear not because demand fell, but because inputs vanished completely. Once mint output slows, secondary markets tighten even further. Then industry feels it. Manufacturers don't speculate on raw materials. They assume availability. Production lines are built around just-in-time delivery. When silver doesn't show up, the choice becomes brutal: halt production or buy at any price. Either path destroys margins. Either path triggers panic. This is how shortages feed on themselves. Each layer reacts rationally, but collectively the system spirals. Hoarding replaces distribution. Price becomes secondary to access, and access becomes totally scarce. What makes this episode different is scale. This isn't a mine outage. This isn't weather. This is the world's refining hub stepping back. And no paper market can ever substitute for a missing physical step. By the time most people notice, the physical metal is already gone. At this point, the timeline matters more than the theory. Supply shocks are not abstract events. They unfold in stages, and each stage narrows your options. Right now, we are still early, but not early enough to hesitate. In the first phase, information is uneven. A small group knows shipments are frozen. Dealers with metal raise prices quietly. Delivery windows stretch, but products remain listed. To the casual buyer, nothing looks broken yet. This is the illusion phase where the market appears functional even as inventory drains from underneath. Phase 2 arrives when delays become visible. Orders that should have shipped don't. Back orders stack up. Customer service scripts change tone. Temporary delays replace firm dates. This is when premiums stop creeping and start jumping. Not because of greed, but because replacement supply no longer exists at any predictable cost. Phase 3 hits when MSM headlines appear. By then, the physical metal has already moved. Public hype doesn't create the shortage. It reveals it. And once exposed, behavior shifts fast. Stackers stop comparing premiums and start securing ounces. Dealers stop selling and start rationing. The final phase is acceptance. The market stops pretending this is temporary. Mines halt. Inventories hit zero. A new price regime forms on scarcity not charts. At that point, entering the stack is no longer a decision. It's a total privilege. Every supply squeeze in history follows this exact arc. Rare earths, energy, grain. The pattern never changes. Only the asset ticker shifts. The mistake most people make is waiting for full confirmation. By the time confirmation arrives, supply is gone. The window exists only while doubt remains. That is exactly where we sit. When physical markets fracture paper, markets don't immediately collapse. They distort. Screens keep updating contracts, keep trading, and prices appear orderly because paper systems circulate promises, not metal. That illusion works only as long as no one insists on taking delivery. Silver is uniquely exposed to this gap. Most contracts are never meant to settle in physical metal. They're rolled forward, netted out, or closed in cash. In normal conditions, that's efficient. In a supply shock, it becomes dangerous. When refined metal stops moving, paper liquidity becomes meaningless. As Swiss exports froze, physical premiums began behaving in ways charts couldn't justify. They decoupled from spot entirely. Dealers stopped asking what silver was trading for and started asking what inventory remained. Price discovery shifted from exchanges to vaults. The real market became the last ounce. This is where many investors make a fatal error. They assume price exposure equals protection. It doesn't. Paper instruments offer claims, not control. In a shortage, claims settle. Control endures. A contract can be closed, a factory needs metal, a mint needs blanks. No spreadsheet fixes that. History is clear on this point. In every physical shortage, paper markets continue functioning right up until delivery stress exposes the fiction. Then repricing happens violently and without warning. Those holding paper discover too late that liquidity is not the same as availability. The difference between owning silver and owning exposure only becomes obvious when supply disappears. By the time that lesson is widely understood, the physical market has already moved on. By the time shortages become visible to the public, the real shift has already taken place out of sight. Industrial users don't wait for headlines, opinions, or market debates. They react the moment shipments fail. And when they react, urgency replaces optimization. Modern manufacturing depends on precision timing. Production lines assume raw materials arrive exactly as scheduled. Silver isn't treated as an investment asset in this context. It's a critical input. When Swiss deliveries stall, procurement teams don't study charts or argue about forecasts. They escalate internally, contact every alternative supplier, and secure whatever metal is available wherever it exists. This is where scarcity begins to compound. Each company acting defensively pulls supply out of circulation. Inventory that could have supported weeks of production vanishes in days. Sellers stop publishing firm prices and start rationing access. Buyers stop negotiating and start competing. As pressure intensifies, governments take notice. Strategic materials don't remain purely commercial. Once industrial continuity is threatened, policy steps in. Priority allocation replaces open markets. When that happens, price signals lose their organizing role entirely. What's unfolding is not speculative demand. It's a collapse in confidence that supply will exist tomorrow. And that loss of confidence changes behavior faster than any price movement ever could. Scarcity doesn't arrive with an announcement. It reveals itself through action, and that action is already fully underway. As the shortage tightens, a dangerous assumption begins to surface that the system will adjust on its own. That new refining capacity will appear. That alternative suppliers will step in, that markets always find balance. In physical commodities, especially ones as specialized as silver, that belief is comforting and wrong. Refining capacity cannot be conjured quickly. It requires years of investment, specialized equipment, trained metallurgists, regulatory approval, and trust. Switzerland didn't dominate silver refining by accident. It built that position over decades while others outsourced, consolidated, or shut down. When 70% of capacity steps back, there is no short-term replacement. Smaller refineries in North America, Australia, and parts of Asia can increase output marginally. But marginal increases don't replace structural loss. They lack the scale, the throughput, and the logistics to absorb global demand. Even if they run at maximum utilization, the gap remains. This is why timelines matter. Over years, markets adapt. Over months, they ration. In the near term, the only mechanism available is price and priority. And when both fail, supply simply doesn't reach those who want it. The belief in automatic adjustment is rooted in financial markets, not physical ones. Paper can be created. Metal cannot. And when infrastructure is the constraint, patience doesn't solve the problem. The system isn't broken forever, but it is broken now. And now is when consequences are decided. History never repeats exactly, but it rhymes with uncomfortable precision. Every time a critical commodity becomes concentrated in one region, and that region restricts exports, the outcome follows a familiar and unforgiving path. Prices don't adjust gently. Supply chains don't rebalance smoothly. Instead, the system fractures and the consequences last far longer than anyone expects at the start. In 2010, when China restricted rare earth exports, the world learned this lesson the hard way. Rare earths weren't scarce because they didn't exist in the ground. They were scarce because processing and refinement were centralized. When exports slowed, prices didn't rise gradually. They exploded. Some elements surged tenfold or more. Entire industries were caught off guard. Governments intervened. And rebuilding alternative supply chains took years, not months. The oil embargo of the 1970s followed the same structural logic. Supply was intentionally restricted. Prices quadrupled. Economic assumptions collapsed overnight. Even after exports resumed, the market never returned to its prior equilibrium. The shock permanently altered behavior policy and long-term planning. Silver now occupies a similar position, not because it's rare in the earth, but because its refining, certification, and trusted distribution are concentrated. When that center steps back, the market doesn't ease into balance. It snaps. The absence of refined metal cannot be solved with contracts, confidence, or commentary. Even if Swiss exports eventually resume, the damage is already done. Trust has fractured. Dependence has been exposed. Market participants will adapt, but adaptation is slow, uneven, and expensive. New refining capacity takes years. New habits form quickly. These moments are never obvious when they matter most. They feel uncertain, debatable, dismissible. Only later do they appear inevitable. And by the time hindsight arrives, positioning is no longer a choice. It has already been decided. So this brings us to the only question that actually matters. What do you do when a physical market breaks? Not in theory, but in reality. Strategy in moments like this isn't about prediction. It's about alignment with how systems behave under stress. First, understand the difference between volatility and scarcity. Volatility is noise. Scarcity is structure. Prices can swing wildly and still function. Supply cannot disappear without consequence. When access becomes uncertain, the value of possession rises faster than any model can justify. That's not speculation. That's logistics. Second, timing matters more than precision. Waiting for perfect confirmation is the most expensive mistake people make in supply-driven events. By the time certainty arrives, availability is already gone. Acting early doesn't require certainty. It requires understanding incentives and constraints. Right now, the constraint is physical flow. That alone dictates behavior. Third, focus on control, not exposure. In normal markets, exposure is enough. In stressed markets, control is everything. Assets you can't access when needed don't function as protection. This applies far beyond silver. It's a lesson about systems, trust, and fragility. Fourth, zoom out. Events like this aren't isolated. They're signals. Signals that globalization is being stress-tested. Signals that strategic materials are being reprioritized. Signals that efficiency is giving way to resilience. Those shifts don't reverse quickly. The most important lesson is simple but uncomfortable. Markets don't break loudly at first. They break quietly, administratively, overnight. And by the time everyone agrees something is wrong, the opportunity to respond has already passed. If this analysis helped you see the market more clearly, take action now. Subscribe so you don't miss what comes next. Share this with someone who still thinks supply chains are abstract. And leave a comment, 1, if you're positioning early, 2, if this changed how you think about risk. Stay rational. Stay ahead. And remember, when physical systems crack, true preparation beats prediction every time.